Welcome to Corporate Banking Snippets. Snippets are short descriptions of key concepts in corporate banking. This is one of 100 different snippets in the process of being uploaded to YouTube. This one is a financial accounting snippet and illustrates how the balance sheet works. In order to analyze and interpret financial statements, we need to understand how they are structured in the first place and what the different components mean. Let's start off with a high-level view. The company's assets are what it owns, while the equity and liabilities explain how those assets have been paid for. Assets fall into two main categories, fixed assets and current assets, while at a high level, equity and liabilities can be broken down into equity itself, the money that the owners have invested in the business, medium-term liabilities, and current liabilities. Now we can further examine each of these headings. Fixed assets typically comprise land and buildings, and separately plant and machinery. These are things that the company uses to produce whatever it is manufacturing, or in the case of a services business, the premises from which they operate and any equipment they use, such as vehicles, storage equipment, or IT systems. There may be other fixed assets, including items such as unquoted shares or trade investments in other companies. Current assets include inventory, that is stock the company is holding for sale, receivables, money the company is waiting to receive from customers to whom it has sold on credit, and finally cash, shown as cash and banks. Equity is the total of what the shareholders have paid in, their share capital plus past profits reinvested in the business, prior year's reserves, plus the current year's retained profit. Medium-term liabilities are obligations maturing more than 12 months into the future. These could be medium-term loans, pension obligations, or other liabilities such as bonds. Current liabilities comprise the current portion of medium-term debt, that is, amounts maturing within 12 months, short-term loans, money due to suppliers, payables or trade creditors, and overdrafts. The cash and bank figure in the assets column and the overdraft figure in the liabilities column are effectively balancing items. If cash is positive, then it appears as cash and banks. If cash is negative, then it appears as an overdraft. Let's add some numbers to provide ourselves with a realistic example for a medium-sized, moderately successful manufacturing company. You can see how both sides balance. At a glance, you can tell from the equity that this particular business enjoys accumulated surpluses, and from the differences between current assets and current liabilities that this is a very liquid company. Check out our snippets on ratio analysis to see how we analyze balance sheets in more detail.